Well, 2050 is obviously a fair while away, 3 decades away, and it's very hard to predict that far out. But what you can probably say is that we're seeing at the moment that cryptocurrencies are here to stay. So you can reasonably assume that in 2 to 3 decades from now, they'll be a far more important part of our financial system than they are now. Specifically to Bitcoin, right now, Bitcoin is fast becoming what's called a reserve asset in the financial system. And by that, I mean it's becoming an asset institutions and perhaps later central banks will have on their balance sheet as a way of holding value for their currency system. So I think it's far from a far probability that by 2050 we see a world where Bitcoin is as important as the US dollar is today. And if that happens, the world will be what's called a hyper Bitcoinized, which is like we will have transitioned, and this will take probably a few decades, but we'll have transitioned from a fiat system of currency to a cryptocurrency based system. Just like in the past, we transitioned from a gold standard where money was based on gold to the current fiat system. I think over the next few decades, we'll transition away from a fiat system. And I think cryptocurrencies like Bitcoin will be where the world ends up. Optimistic scenario where Bitcoin, the world is run on Bitcoin, you're probably looking at a price in the millions of dollars. So for example, right now, if Bitcoin replaced gold as a sort of alternative asset outside the financial system, then you'd be looking at about $500,000 per Bitcoin to replace the gold market. If Bitcoin was to replace the US dollar in terms of M1 money supply, which is a gauge of the total number of dollars around the world, then you're looking at today's prices at about $10 million per Bitcoin. But I think as we've all seen over the past year or past few years, reserve banks are pumping money out into the system willy-nilly at the moment. They're just, loading the world up with more and more US dollars. So if we're going to look this far ahead into, 3 decades from now, you would imagine in that time they'll have pumped out more dollars as well. So $10 million per Bitcoin at today's money supply, but the money supply of US dollars over the next decade could grow immensely. So you could be looking feasibly for Bitcoin, hundreds of millions of dollars per Bitcoin. Remember the fact there's only ever going to be 21 million Bitcoin. So these, in the future, your kids or grandkids, someone holding 1 Bitcoin could be the equivalent of a Rothschild or a dynastic wealth family. So that is a potential outcome. And not to say the probability of that is definite, but in my opinion, it's a lot higher probability than what people realize. So my simple advice to anyone thinking about investing in cryptocurrencies today is the first 2 things you need to do is have a core holding of some Bitcoin and some Ethereum as long-term investments. And so when I say long-term, I mean money you can set aside and feasibly leave for the next 3, 4, or 5 years. And don't be influenced by the volatility in price because cryptocurrencies are volatile. So have a core holding of definitely Bitcoin and possibly Ethereum as well. And that's your long-term crypto holds. However, the thing to realize about cryptocurrencies is that it is an emerging ecosystem full of different ideas and investment opportunities. It's very similar to the dot-com boom in the year 2000 when there was lots of internet companies that sprung up from nowhere. And in the moment, it's very hard to know who's going to be the next Apples or the next Amazons and who's going to be the pets.com that went bankrupt and things like that. So a lot of cryptocurrency projects will go bust, but the ones that succeed will do very, very well. So in my opinion, the best way to trade that opportunity is to be a little bit nimble in your thinking and to complement any research you do on a project's fundamentals with a proven trading strategy as well. So in my strategy, that means looking at stuff like on-chain data, looking at the fundamentals of a project, the people backing it, and then trying to work out if it's worth taking a position in a project at a certain time, and then monitoring that. Sometimes you get into a project and you stay on it for a little while, and then you might decide to get out of that project because something might not be going quite right with it. So you have to be a little bit nimble. The problem a lot of people make investing in this kind of opportunity is they choose maybe 3 or 4 favorite projects and then they just stick on them no matter what. In my opinion, you have to be a little bit more nimble and not be so loyal to your top 3 projects. You have to be willing to be wrong and be willing to criticize your own thinking. And like I said, the best way to do that is to have a trading strategy on top of any fundamental analysis you do. Cryptocurrencies are risky, and there's a number of risks: regulatory risk, technology risk, the risk of just making a bad investment. There's even some personal risk where you can lose your own keys or make a mistake. And with cryptocurrencies, they're great in the fact that you have ultimate control over what you do, but the flip side to that is that if you make a mistake, there's no customer service to help you out. So there are risks. The best way I say to people to handle risk is to think of it on a portfolio basis. So think about their entire investment strategy. So they might have some property, they might have some shares, they might have some retirement savings, they'll have an income and a job, and that all forms their financial portfolio. So the way you handle risk with cryptocurrencies is you decide how much of your portfolio you want to put at risk. So for someone that's fairly risk averse, you might just have 1% of your portfolio in cryptocurrencies. That way, if worst comes to worst, you're only going to lose 1%. If you're a little bit more, you don't mind taking on a bit of risk, maybe you're younger, maybe you've got more time up your hand, and maybe you understand this space a bit better, you might have 20% of your portfolio in cryptocurrencies. So that's the best way to manage it. Not to say it's risky, I won't do it. It's to acknowledge that there are risks and then decide how much of your portfolio you're comfortable giving those risks. But always remember that this is what I call an asymmetric opportunity for investors, meaning that the upside is huge, 10 times, 50 times, maybe even 100 times what you put in. The downside is you lose it all. So thinking about that, that's an asymmetric opportunity. The upside is a lot more than the downside, but the downside can still be quite severe if you don't get your allocation strategy correct. The only one you could probably hang your hat on and say is definitely going to be here 3 decades from now is Bitcoin. So like I said, if you do nothing else with cryptocurrencies except get a core holding of Bitcoin for the future, for your kids' future, for your grandkids' future, that's the one thing you should do today. There are better opportunities in more speculative cryptocurrencies, but the risk of them succeeding is a lot higher than what it is with Bitcoin. So yeah, Bitcoin's your 3-decade hold. But there are other opportunities for someone that wants to take more of an active interest as well.